Corporate finance practice problem using OneNote. MACRS Depreciation, cash flow, and net present value problem 2. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We're going to be pulling together some of the things that we looked at in prior presentations in one practice problem here, imagining that we're investing in a long-term asset, a fixed asset, with a 3-year MACRS depreciation, and then we expect to receive returns on that initial investment related to years 1 through 4, as can be seen here. Tax rate assumed to be 35%. Cost of capital is going to be the 9%. So the added component we're going to look at here is to be calculating the MACRS depreciation. This is an estimated calculation, so note that the tax law can change from year to year. You might have bonus depreciation, 179 depreciation that you got to take into consideration. And of course, you got to project out whether or not the tax law is going to change from year to year and take that kind of into your projections as well. But we typically have the standard kind of MACRS type of depreciation applicable as well. We want to have an understanding of that, so we'll do a recalculation of it, and then we'll take a look at our cash flow, taking into consideration the tax impact of the tax depreciation, and then we can take a look at our flows in terms of a net present value calculation and a quick internal rate of return calculation as well. So we have our purchase of equipment. We're going to say that it costs us the $500,000 we're going to be putting down. We're going to say that it's a 3-year MACRS fixed asset. Why is that important? Because depreciation, although it's not going to be a cash item, it does have an impact on taxes. Therefore, when we calculate depreciation, we want to use tax depreciation because that's the depreciation that's going to have the tax impact. And we have to then, and there's less leeway with the tax depreciation. You got to use whatever it is you have to use. So you got to determine what kind of property is, what depreciation schedule it falls into. Whatever we can depreciate, we usually want to depreciate more in the beginning years. The kind of normal depreciation methods for fixed assets, business assets, are typically what are called MACRS depreciation, which is kind of a format of double declining balance, which we'll focus in on here. So we're going to assume it's a 3-year MACRS depreciation. Note that you can look in more information on depreciation by looking at the IRS website, irs.gov, irs.gov. Type in publication or pub 946, and you can get some more information, including table 1A, which will give you a kind of simplified method to determine your depreciation amounts. We're going to do a calculation which will estimate these amounts. May not be exact on them due to rounding and due to some changes in the later years that kind of deviate from a standard double declining half-year convention. But it's useful to do because, one, it's an estimate. So, you know, it doesn't have to be completely exact when it's an estimate. You have to basically have a good round number for the estimates typically. And 2, it's a good idea to have a general idea of what's going on with tax depreciation and possibly contrast that to book depreciation. So let's do that calculation first. We're going to say the cost. We're going to look at our MACRS depreciation here for year 1. Picking up the $500,000, we're going to say the years involved are going to be 3 years because it's a 3-year property. I'm going to go to the font group and underline that. That would give us our straight line depreciation method per year in a dollar amount format. If we were to divide that out, that would be the $500,000 divided by the 3 years, in other words. And that would give us the 166,667. Then we're going to take our cost. The cost is going to be equal to the 500,000. And I'm going to get my percentage straight line percent depreciation. Straight line percent depreciation then being equal to the 166,667 divided by the cost. And making that a percent number group percent, adding decimals. 33.33. It goes on forever in Excel. Note the tables will round it. That's one of the things that'll be different when you work at it with the table. It'll round it to 33.33 instead of 33.3333 on forever, as is calculated here in Excel. Note you can also calculate this as 1 divided by the years, or 3, and get there a little bit faster. That too giving you your 33.33. Closing that out, then we've got the times 2 to make it double declining, times 2. So 2 times, because it's double declining, And that's going to give us our double declining method, sometimes referred to as capital D, DD method. This is going to be the 33.33 times 2, making that a percent, number group, percentifying, add a couple decimals. That's the percent we're going to use. Then I'm going to take the cost, which is going to be that 500,000 here. That's the depreciated cost or book value, as we'll see going forward. Font group and then underline. And then if we multiply that out, that's going to give us our double declining rate for the year, for an entire year. Multiplying this out, 500,000 times this 0.6667%. And then we have a half-year convention. So whenever we put this in play, even if it was January 1st, generally, again, there could be exceptions if you buy all your equipment at the end of the year or something like that, but generally, we assume you purchased it right in the middle of the year, and therefore we only want 6 months of depreciation, not an entire year, so I can divide it by 2. Divided by 2, underline, and finally that gives us our MACRS depreciation for year 1 here, equaling the 333,333, I may have said one too many threes, divided by 2. And that gives us the 166,667. And you might say, hey, look, that's the same number as the straight line. You could have stopped right there. What are you doing? Why do you keep going? Because that means that that is the same as straight line, but for a reason different than us doing this as the straight line. Next time, if we apply the same concepts as a straight line concept instead of double declining balance half-year convention, we'll run into a problem. So just, realize that. That's kind of confusing. That's a little confusing because it makes you think it's straight line method, but it's not. It's double D half-year convention. All right, so then we're going to go over and say, let's pick up the same percent, which I'll calculate just as 1 divided by the 3 here. Let's do that this time. Making that a percent numbers group, percentify, and there we have that. Actually, I'm sorry. Let's just say this is going to be equal to the 66.67, or you could say it's 1 divided by 3 times the 2, if you want to do it that way. And then we got the depreciation is going to be, this is kind of like the book value. It was the 500,000. Last year we depreciated 166,667, so we're left with 333,333 about. And then we multiply that out times the 66.67%. Underline in here, font group and underline. We have no half-year convention because this is an entire year, so that doesn't apply this time. So there we have that, and then let's do it again. I'm just going to say this equals the same percent. Numbers group, percentify, add some decimals. Book value now is going to be what we had before, minus the 222,222. That gives us 111,111. And then we're going to go to the font group and underline and multiply that out. Percent times 111,1111. That gives us 74,074. No half-year convention. And then the last year is kind of funny because we kind of just used the plug here to close this thing out. We're going to just do whatever we need to do to get to what we need to get to, which is we're left with the 111,111 is minus the 74,074. That there, no half-year convention here, and bottom line is if I add this up, then I should get to the 500,000 after the 4 years with the half-year convention in 1 and kind of the plug in year 4. So it's 3 years, but kind of a half year here and a half year here, and then the double declining method, it's kind of a plug at the end. So the sum of these should mean that we depreciated over 4 years the 500,000 because it's the 3-year property with the half-year convention thing going on. Okay, makes perfect sense. So now let's do the cash flow calculations here now that we have our depreciation, because we got to take into account depreciation to figure out the tax impact of it. So we're going to say there's our cash flow before was 250,000, and then we have the depreciation that's happening here. That's what's going on with the depreciation. Let's do this a little bit faster. We've seen this in the past, so let's break up my cash flow for each year and see if we can do this faster this time. We're going for speed this time. Speed is a factor. This is a timed exam. So we got cash flows all the way across the board, now in a horizontal fashion. Now I'll do the same for the depreciation. So depreciation we calculated on down here. I'm just going to pick that one up and I'm going to copy it across. Going to say Control C, right arrow holding down Shift, and then Control V, double click to see if it pulled over what it should on the last one. It did indeed do what it should have done. So then I'm going to go to the Home tab, Font Group, and underline. Earnings before taxes then for each of the years is going to be equal to the 250 minus the 166,667 or so on. Going to copy that, Control C, right arrow, holding down Shift, right, Control V, pasting. Double click on the last one, does what I wanted it to do. So let's keep moving on, shall we? We shall. Tax effect. Tax effect is going to be that 83,333 times the tax rate, which is 35%, for crying out loud. That's a lot. Calm it down with taxes. And I'm going to make that an absolute reference by putting a dollar sign before the B and the 10, so that when I copy it across, because that's outside the table, I don't want it to move. So we're going to copy that, and then I'm going to copy this and Control, holding down Shift over and Control V, paste it. Double clicking the last one, see if it did what we want. Did it pick up the proper rate? It did. Didn't move it. Why? Because it's an absolute reference, and that's what absolute references do for us, and we're thankful to have them. Font group and underline, and then we're going to say we have the earnings after taxes is going to be equal to the 83333 minus the taxes. Copying that, Control C, right arrow, holding down Shift, right, Control V, pasting it on down. There we have that. Then we're going to add back in the depreciation because it's a non-cash factor, and we just added it in just for the tax impact, because taxes are really messing up our calculations, making it way more complicated than it otherwise should be. That's what taxes do. That's what governments do in general. Home tab, font group, and underline. Then we get the cash flow on the bottom line. Cash flow bottom line equals the SUM, Shift 9, sum up. And then we're going to copy that and paste that across. There we have our cash flows. Now that we have our cash flows, we can now use this to figure out our present value, net present value, and possibly the internal rate of return. We could do it in a vertical fashion as we've seen in the past, and we will do that. But you might say, hey, why don't I just continue the table on and do my net present value here? So I'm going to set up my table, net present value. I'm going to put my years up top, and I want to put them as one cell each year so I can copy them across horizontally in a similar fashion as we did vertically in prior presentations, and then we'll do it vertically too, so you can remember how we set it up before, which I think is a better way. But you can see how you can kind of tack this on to the same table, and you might prefer that. That might be a preferred method for some people, and I can see why. I can understand that. So we'll do it that way too. So we're going to say, let's just bring the cash flow back on down, cash flow, and copy that and paste it on over. Paste it on over. And then we'll do the net present value calculations here, which are going to be, this is the same net present value, but now we're doing it horizontally. So negative present value, Shift 9, rate, all the way to the left. It's going to be that cost of capital, 9%, which might be the hurdle rate. The cost of capital, it might be the discount rate. You know, it could be required rate of return. You know, they might call it different things. And then F4 on the keyboard, then comma. That made it an absolute reference, so I could copy it across, which we won't do yet, but we will do soon. And then we'll go to the number of periods, which is 1 year out for this one, comma, because it's not an annuity future value, the amount above it. So we present value that 228,833 to 202,599. Let's do it again over here. Negative PV, Shift 9, rate, all the way to the left, 9%, F4 on the keyboard, making it absolute, dollar sign before the B and 12, comma, number of periods, up twice to 2, comma, because it's not an annuity, up once for present value of 1, tab, do it again, negative, present value, Shift 9, rate, all the way to the left, 9%, F4 to make it a present value, dollar sign before the B and 12, comma, number of periods, up twice, 3 of them, comma, future value, up once, and enter. So I won't do it the last one. Let's copy it across over here and do that just to show that we could do that. So I'm going to delete these two and do my autofill on the horizontal autofill, which we haven't been utilizing as much. But the car can drive down and it can drive horizontal here. So note that this is an absolute reference on the rate because it's outside the table. So I don't want to move the rate. And as long as that is the case, I can grab this and use my fill handle. And instead of dragging it down, I drag it to the right. Drag and fills handle all the way to the right to period 4. Double click on that last one. Make sure it does what I think it should, meaning don't move this rate. Don't move that rate. It didn't. It did what it should. So we got it. So I think that's good. Equals the SUM this way. Now we have to include in this table our initial investment now, which was all the way to the right. I'll just put that all the way to the right. Negative of, I'll make it a negative for the outflow of the 500,000. That's how much we put down for that piece of equipment. It was an expensive thing, whatever it is we bought. It better make us money because it cost us 500,000 put down right here, right now. And then we'll sum this up, equals the SUM. And so there we have it. Now it's a negative number, so that means we didn't get our required rate of return, which we said was a 9%. It's not too negative, so we're pretty close. So we might want to calculate the IRR, internal rate of return, which we'll do shortly. Like the vertical calculation now, let's calculate it the way we've seen it before this time. So I'll do this quickly because we've seen this before. I'm going to say 0, 1, 2. I forgot the 0, 1, 2. And then we'll copy that down. Autofill. Alignment, center, please. And then we'll pick up our flows here, the flows. Well, that's not the right flow. On period 0, it was the 500,000. I'll just pick it up down here. And then the flows were this. For year 2 was that. And for year 3 was the other one. And for year 4, it was that one. And then we'll underline that. Let's font group and underline, drawing a line right underneath, equals the SUM, totaling it up. If we had no time value of money, we're talking 84,500 total cash flow at the end here. But we need to do some present valuations, which we'll do fairly quickly because this is the format we've seen in the past. Present value, shift 9, rate all the way to the left. We're looking at that 9%. We're looking at you 9%. F4, making it an absolute reference, $ before the B and 12, comma, number of periods, 0, comma, future value, 500. Copying it, Control C, down arrow, holding down Shift, down, Control V, and then we will underline, font group, underline, and sum it up equals SUM, Shift 9, summing it up. So we're slightly on the negative. Let's see what the internal rate of return would be, shall we? We'll just do the formula down here. The IRR is going to be equal to the sum of these items, and it's about 8.57. And what we wanted to clear was the 9%, which we totally would have done if it wasn't for taxes being 35%. We would have cleared the investment. So if there's any way we can lower the taxes, maybe we would do it. So maybe if we've got some lobbyists, paid some lobbyists to tell Congress lower the taxes, maybe then we take it on or something like that. But see, so we'll pull in everything together here and obviously into one practice problem.